former Reagan economic advisor and Laffer Associates chairman. I have to admit, oh, there's your book, by the way, Taxes Have Consequences. Indeed, they do. And that's what we're going to talk about. But full disclosure, I have to mention that the article was written by Brian Domitrovic, who is with an organization called the Laffer Center. So it's kind of a rhetorical question. I know you kind of agree with what Brian said. It was a brilliant article. His point is that we don't need to have a recession in order to lick inflation. Do you agree?
Yes, totally agree. In fact, just the opposite. If you want to lower the price of something, increase the supply of goods. If you have a bumper crop in apples, David, what happens to the price of apples? They go down. What you really need to do, instead of reducing demand by creating a recession, you need to increase supply, which lowers the price and brings down inflation, just the way Reagan and Volcker did it.
So how do we increase supply?
Deregulation. Low rate, broad-based, flat tax, lower tax rates there, control government spending, free trade, and all of that, and then, of course, a sound money. There's nothing that can bring an economy to its knees quicker than an unsound money. Witness the U.S. today. Low rate, broad-based, flat tax, spending restraints, sound money, minimal regulations, and free trade, and then get the heck out of the way and let the market solve it, and you'll see inflation coming right down, stabilize prices with economic growth.
It's a beautiful thing, and it's happened before. It's not like we're just making it up at some Harvard economics class. This is actual reality. That's what happened in the 80s. Now, Paul Volcker, of course, is given complete credit by the media and historians for killing inflation. And yes, he let interest rates rise up, and that was very important. But what really killed inflation were the Reagan tax cuts, which, when they kicked in, had this enormous increase in growth, and we had an enormous increase in supply, and it was that extra supply that brought down the prices, right?
Yeah, and let me, if I can, say about Volcker. Volcker was not Powell. Powell is raising interest rates, controlled interest rates up. Volcker let them go. Yes. You know, right when we were coming into office, the prime interest rate was 21.5%. He didn't try to control the 10-year bond yield. He tried to let markets, so he didn't sit there and buy government bonds and thereby create a huge monetary base, which caused the inflation. Volcker kept the monetary base tight, let interest rates rise to their natural level, did not hold huge balance sheets, and that, in conjunction with supply-side economics on the growth side, brought inflation. If you look at the plot of that, David, and some show you should have it, just what happened to inflation under Reagan, it goes, and just boom, straight down. It didn't take any time. It wasn't 20 years in the making and we're going to have to suffer a huge depression. No, it's growth and tight money, and that'll do it. Bob Mundel's model all the way.
And by the way, the fact is that what Volcker did essentially was to avoid becoming a central bank. He turned the central bank into what's known as a currency board by just letting the rates find their own place. And it makes you wonder, maybe we don't need a Federal Reserve to do all these special buying up of bonds in the marketplace and so forth. Maybe we just need a simple currency board to just let things go, let rates find their own place.
Yeah, I don't know if you remember when you were at the Wall Street Journal, David, but I did a piece with Chuck Cadillac called The Price Rule that Volcker put in a price rule. I spent about 3 or 4 hours with him on that. He explained exactly how he did the price rule. We published it right there in the Wall Street Journal, just how he did it. I did a piece called The Bitter Fruits of Devaluation, which was in 1974, which was when the dollar went off gold, stops having a sound money, devalued the dollar, how we would have double-digit inflation. Sure is. I mean, the bitter fruits of devaluation, all those articles we were all writing, you were right involved with all that in the journal, made it very clear why we had inflation and how we could get out of it, and it worked. Just as true today as it was then. It
worked. I mean, that's the bottom line. You don't base your economic policies on something created by an economics department at an Ivy League college. You do it on the basis of what happens in the real world. It is the real world we're talking about.
Well,
I just have to quickly switch gears.
With the Harvard,
we're running out of time, but I just want to focus on one thing. Sir. And the word now coming out of the United Kingdom is that it is actually becoming more expensive to charge your electric car than it is to fill up a gas car. And as a result of that, they're having terrible problems with their electrical grids over there. They have to start up old closed down coal plants, which means the air is getting dirtier and the energy that they're using is getting more expensive. Is that what's coming here?
I hope not. But if it does, it does. You know, these people deserve the countries they get. And these politicians are the earth they are burning and raging on is their earth too. And you know, when you look at the scorched earth policy these people have done politically to get what they want, you know, I don't know if they're going to be really happy with what they are going to get.
Yeah.
And frankly, people who vote them in, let them vote them in. It's their country too. And I'm perfectly willing to live along with them. I'll do just fine with their policies. But it's not good for our country.
No,
it's just not good. And we need good economic policies to bring prosperity back to our country.
Yeah.
And they're not doing it.
Do what works in the real world, not just what works in the heads of those Ivy League professors. Art Laffer, good to see you, my friend. Thank you very much for being here. Appreciate it.